Hello, I'm John Weicher, Senior Fellow at the Hudson Institute and Director of Hudson Center for Housing and Financial Markets. Housing has been in the headlines for more than a year now, ever since the first lenders started to realize that they were running bigger losses on their subprime loans than they had anticipated. The situation came to a head this summer when Fannie Mae and Freddie Mac collapsed, along with several large Wall Street firms, and a few big banks had to be taken over by other banks because they were in danger of going bankrupt because of the poor performance of their portfolios of subprime mortgages. The next president and the next Congress will have to deal with the problems in the housing market. Specifically, they'll have to face two problems. First, how to help the families who are now in trouble and in danger of losing their homes. And second, what to do to keep it from happening again. There are already a number of programs that are helping families in trouble on their mortgages. More than 2 million are being helped by a private program developed by lenders and housing counselors, which helps them modify their mortgages so they can make their payments, certainly over periods when they're in economic difficulty. There is a program run by the Federal Housing Administration, FHA program, where several 100,000 families have been able to refinance out of subprime mortgages and into mortgages carrying FHA insurance and carrying a lower interest rate, which reduces the payment that they have to make. Another FHA program, which will help additional borrowers, started this last month at the beginning of October. And the federal government has appropriated about $4 billion to state and local governments so that they can afford to buy homes that have been foreclosed in their communities. It's not quite clear how this money is going to be used. It should be enough to enable state and local governments to buy 20,000 to 40,000 homes. Now, $4 billion is a lot of money. 20 to 40,000 homes is not a lot of homes. But taken all in all, these programs probably are helping over half of the families with subprime mortgages now in the United States. There are between 5 and 5.5 million families that have subprime mortgages. And we are seeing signs of progress. The number of subprime mortgages has dropped by about 400,000 in the last 9 months, which is about a 7% reduction. And there's been a small reduction in the number of families who are delinquent on their mortgages, who are behind on their payments in the last 3 months. This is all to the good. But the problem is not really behind us. The typical subprime mortgage in recent years involved a very low interest rate for the first 2 years of the mortgage, followed by a high rate above the market for the remaining 28 years of the mortgage. The last big group of these subprime adjustable rate mortgages was issued in the first half of 2007. They're going to reach the point at which the mortgage rate adjusts to the much higher rate during the first half of 2009. When that happens, many families will have difficulty making their mortgage payments, and there will probably be a final wave of defaults on those mortgages. So the problem is not going away. The next president and the next Congress will need to consider whether they think something else needs to be done in addition to the programs that are already in place. The second question that the next president and the next Congress are going to confront is, how do you keep this from happening again? There are a number of suggestions that are being made. These are often complicated, and to this point, no real efforts have been made in this direction. This is very much a question for the next president and the next Congress. There are suggestions for tighter regulation of subprime lenders, who typically now are not regulated by the major financial regulators, the Federal Reserve, the FDIC, and for tighter regulation of mortgage brokers. These are the firms that help home buyers find loans. They don't make the loans themselves, but they help home buyers connect with financial institutions and other lenders who do have the money to lend. There is a concern that mortgage-backed securities are very complicated, and so investors don't really know what it is they are buying and what the terms of the payments are going to be and what the risk is that they are accepting. There's a concern that home buyers don't really know what they're getting, that they don't understand the terms of the mortgage. For instance, that the adjustable rate mortgages that I was describing a moment ago have many home buyers who really do not understand that their rate is going to rise sharply after they've had the mortgage for 2 years, and it will rise regardless of what happens in the market, in the mortgage market. There are concerns that lenders need more capital. This is particularly a problem for Fannie Mae and Freddie Mac, which have had much lower capital requirements than other major financial lenders and other institutions in the housing finance system. All in all, the general idea is that many entities have been engaging in risky activities without the resources to back those risky activities, and in many cases without knowing exactly what they were doing. While there's agreement that these are general problems, there is by no means agreement among all interested individuals as to what should be done. And therefore, the next president, the next Congress clearly have something to do. These are not easy questions, but they are urgent questions. There's certainly a general agreement that the housing problem remains at the root of the problems in our general economy, and if we are not able to solve the housing problems, we will not be able to solve the problems in the general economy. So it's safe to say this will be very high on the agenda of the next president and the next Congress next January.